Good morning. You're watching All You Need to Know on BloombergQuint Live, and I'm Alex Matthew. First, the headlines. The Cabinet approves the strategic divestment of 5 PSUs. That's BPCL Shipping Corporation, Container Corporation, THDC and NEEPC. Management control in these PSUs will also be given up. The Cabinet will also defer the receipt of spectrum auction installments due from telecom operators for the years 2020-21 and 2021-22. The Reserve Bank of India has superseded the board of Dewan Housing Finance. It will also refer the company for resolution under the new insolvency window for financial service providers. SL Group promoter Subhash Chandra will sell another 16.5% stake in Zee Entertainment, thereby bringing the promoter stake down to 5% and losing control of the company. And the Securities and Exchange Board of India has asked companies to disclose any default in repayment of loans if the delay extends to beyond 30 days. So there's clearly lots to talk about in the domestic space, but first let's take you through the international markets. US markets ended off the day's low, but with losses on Wednesday. This after reports suggested that the trade deal between the US and China may not be signed this year. China's condemnation of the resolution passed by the US Senate supporting Hong Kong's protesters has also soured sentiment. Ritika Gupta of Bloomberg News tells you what happened during that Wall Street session in this report.
There was a risk-off tone on Wednesday as we continue to retreat from record stock market highs reached earlier in the week. The S&P 500 and Dow Industrial ended Wednesday down 0.4% lower, whilst the Nasdaq was down 0.5%. The biggest overhang for the markets continues to be US-China trade talks, and there was concern about American support for Hong Kong protesters that would just complicate these trade talks further. We also then got reports that the Phase 1 deal could be pushed into next year, and we saw this reflected in the Treasuries market, which got a real bid with the yield on the 10-year falling to a 2-week low at around 1.73%. And as the yield fell, we saw that curve flatten. The spread between the 2 and the 10-year yields fell for a 6th consecutive session to just 16 basis points. And it's no wonder that with the yields falling, financials were one of the big drags on the S&P 500. But the bigger laggards were the autos and telecom sector, again on that trade news. But to the upside, we saw some of those defensive sectors like utilities and consumer staples gaining, and these tend to do better when rates are lower. And a couple of stocks to watch are the retailers Lowe's and Target, which reported better than expected earnings per share in their results, and Target shares in fact rallying to their highest on record, surging 14%. Now turning to energy, which was the best performer on the S&P 500 on Wednesday. That after data showed that American oil stockpiles expanded less than expected. WTI crude ended the session up over 3%. Some of the leading stocks in that sector were Schlumberger, Halliburton and Noble Energy. Now away from stocks, we also got the FOMC minutes out on Wednesday, but there was no surprise there. The FOMC sees policy on hold. That's your US Wednesday markets wrap. I'm Ritika Gupta in New York with Bloomberg TV.
All right, let's quickly turn to the Asia-Pacific region as well. I'm joined live by Rosalind Chin from the Bloomberg studios in Hong Kong. Good morning, Rosalind. Well, seemingly that risk-off sentiment is spreading to Asia as well this morning.
Absolutely, a risk-off tone spreading across the Asia-Pacific region. And of course, the prospect really of President Trump signing that legislation supporting Hong Kong protesters really dampening the mood across the region. We did have China Cabinet Advisor Huiyao Wang on Bloomberg, who said that signing the bill might dampen the hope of a deal. So of course, there's the prospects of that trade deal coming through also be weighing heavily on investors at the moment. Stocks across the region pulling lower. In Hong Kong and China, those markets opening lower. We've got the yuan weakening to a 3-week low. The yen has been gaining on risk aversion, of course, again on the trade China-US trade issue as well. Last check, it was at 108.37. In Korea, we had some data showing that exports for the first 20 days of November fell 9.6% year on year. The semiconductor shipments slumped 24% year on year. Now, while that does seem bad, it's actually already an improvement from October, because in October they were down 32%. And And in Singapore, a few little sparks of hope poking through here. They see economic recovery next year. The outlook for GDP growth of 0.5% to 2.5% growth for 2020. Third quarter GDP grew 2.1% quarter on quarter on an annualized basis against estimates of 1.8%. So it's not all doom and gloom. There are a few little green sprouts of hope in the region, but right now many of the markets here are in the decline. Back to you.
Thanks so much for that, Rosalind. I want to talk a little bit more about that Hong Kong issue. The US President Donald Trump is expected to sign a bill into law that supports the protesters in Hong Kong. The bill was passed by both houses of the Congress earlier. China, however, has condemned the passage of that bill. So what sort of implications would this have on the impending Phase 1 deal between the two nations? Jody Schneider and Derek Wallbank of Bloomberg News bring you more details.
The legislation basically would require the State Department to certify annually that Hong Kong remains sufficiently autonomous in order to from China, that it has the sufficient autonomy to be able to justify that special trading relationship that Hong Kong has with the U.S. It's treated differently than the rest of China. It's symbolically, it's a warning from the U.S. Congress to China that they are taking seriously the situation in Hong Kong. They don't want to see a crackdown from China, and a bit of a warning that they're paying attention to what's going on. As you noted, President Trump is expected to sign this. It has drawn comments of possible retaliation from China if this was to pass and be signed into law. So this certainly will heighten tensions between the U.S. and China, another area where there will be escalating tensions.
So Derek, what's the latest with the trade negotiations on this potential Phase 1 deal that we've been hearing about for so long?
Well, if you want to know a really fun fact that I might think is fun, you might think is a little bit depressing, that Phase 1 deal was supposed to have been signed last week at the APEC meeting in Chile that never happened because that conference was canceled. We're still in talks about that Phase 1 deal. They are described as being in a very sensitive stage right now, and certainly the Hong Kong legislation that the Senate passed without objection and the House passed with exactly one no vote, and that President Trump, we are told, is expected to sign, is probably going to complicate that in some fashion. Again, talks in a very sensitive stage. It really does, though, bring in play for markets and traders the idea of this December 15 deadline. That's the next time that tariffs are supposed to ratchet up. Now, interestingly enough, President Trump was in Texas at an Apple factory, and he said that he is looking at exempting Apple from some tariffs. The December 15th stuff is actually going to kind of hit some Apple products, but he said that you want to kind of treat Apple and Samsung on a roughly even plane, and so there's a possibility that the president may exempt Apple from any of those things that might be coming next month.
All right, so that's what's having a bearing on the markets as of now. Let's also talk about the minutes of the Fed meeting that were released yesterday. They indicated that the FOMC agreed to keep interest rates on hold for the foreseeable future. But the minutes also suggested that the 3 insurance cuts that have been done so far have not been enough. Kathleen Hayes makes sense of the divergent commentary.
We listened to Jay Powell's press conference when he came out of the October 30 meeting, and after making their 3rd rate cut in a row, made it pretty clear economy's in a good place. We are going to wait and see what happens. Basically, he never used the word pause, but that's exactly what everyone concluded. What you see in the minutes is, yes, there were divergent views. Yes, there was a debate, but it looks like the majority came down on Jay Powell's on his side, I should say, because quote unquote many saw elevated downside risk, underscoring the case for a rate cut. In other words, they have paused, but they're waiting to see what happens and if they need to move again. Here's a very important sentence. Risk to the outlook associated with global economic growth and international trade were still seen as significant. The risk that a global growth slowdown would further weigh on the domestic economy remained prominent. Now, if you think about it, at the end of last month, I think people were more confident about this trade deal getting done, Phase 1 deal. Well, after what we heard today especially from President Trump, maybe it isn't as much of a done deal, and maybe this is something that could eventually push the Fed toward another rate cut. But of course, it's going to have to show up in the domestic economy. Now, another thing we're showing you here is, again, a breakdown, because when you read the FOMC minutes, you have to understand what most mean. Most means a majority. Most said, okay, with this, we do see policy well calibrated. Again, we've done enough. Now, some said they didn't think the economy needed this cut. I think you could put Raphael Bostic from the St. Louis Fed on that list. And a few were worried about financial instability, the risk of that. Keep rates too low, too long, people chase yield. That could be an issue. Well, that has to be Eric Rosengen from the Boston Fed, maybe Esther George from the Kansas City Fed, because they dissented from rate cuts all year long. One more interesting thing. Not the main thing to come out, but it's eye-catching. Negative rates have been rejected by the entire FOMC. They all agreed on that. They don't think it's an attractive policy tool for the U.S.
All right, now let's see what else is making headlines across the globe before we turn back to India. Sue Keenan of Bloomberg News brings you the first word headlines.
There are signs of a recovery in Singapore, where the economy expanded at a faster pace in the third quarter than was earlier estimated. The final GDP rating showed annualized growth of 2.1% from the previous 3 months, and that is far better than an earlier projection of just 0.6%. The Monetary Authority says policy is appropriate at the moment, but it may change as the economy evolves. To South Korea now, where exports are poised for a 12th monthly decline as tech demand struggles and China continues to slow. Shipments during the first 20 days of November fell almost 10% from a year ago. Deliveries to China, which is South Korea's biggest trading partner, dropped more than 8%. Now, semiconductor sales account for the largest share of exports, and they fell by almost a quarter. The impeachment hearings, meanwhile, in the U.S. have been told that President Trump's personal lawyer demanded a quid pro quo from Ukraine by delaying a White House meeting unless Ukraine carried out an investigation into Joe Biden. U.S. envoy Gordon Sondland told lawmakers that Giuliani was working at the president's direction. Sondland also denied any rogue diplomacy in Ukraine, saying, quote, everyone was in the loop. The latest Fed minutes show that policymakers saw elevated risk to the economy, even as they agreed to keep interest rates on hold after a third cut this year. The minutes, which were released in the most recent session, say threats include weakening global growth and trade, with the concern that a general slowdown would weigh on the domestic economy. The Fed has signaled that rates will remain on hold until there's any material change in the outlook. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan, and this is Bloomberg.
All right, let's turn attention back to India now, and there's clearly lots to talk about. Agam Vakil is here to set you up for the day's trade and also to tell you what's happening in the futures and options space. Agam, we've just wrapped up global markets. We've talked about how they are. They're not looking great, but then we have a lot of other, actions that were taken post-market yesterday that could have an influence today. So how are we looking?
Well, certainly a lot of developments coming over the evening. Of course, that the divestment will be in focus. We have Zee Entertainment, Diwan Housing Finance, all are heavily traded companies in the futures and options space too. But I'm going to start off with the SGX Nifty futures because we are seeing some amount of weakness in the Asian markets, and the SGX Nifty is taking cues from it. There's a likelihood that we could see a negative start. That said, let's take a look at how we have seen your other, indices will pan out. For now, we're looking at 0.5% gains yesterday, and mid-cap and small-cap indices, just a tad behind. And the banking indices are seeing a mixed day of trade. The public sector space, specifically in this case, we saw a little bit of profit taking coming through. ADRs are definitely a mixed picture. As you can see, we aren't really seeing any distinct trend here. But, on the whole, Dr. Reddy's perhaps stands out here because it's seen an up move around 3.5%. But let's talk about your fund flows, and we are looking at 567 odd crores coming in from FIs. Do remember this is after looking at a net sell figure the day before. So there is no exact trend for foreign institutions either. And DI is, of course, buying to the tune of 183 crores on a net basis too. But we did see a lot of strength in Reliance Industries, and it's something that we had pointed out yesterday as well, that if there was one stock that would lead the index higher, and well, the Nifty to nearly 12,000, it was Reliance Industries, and that's how things have panned out. We saw a little bit of surge in Sun Pharma as well, in the second half of the day on account of the news surrounding Taro. But let's move on and talk about futures and options. And what we have seen is unwinding, short covering to a certain extent. But it's a wait and watch whether or not the Nifty will hold on to these levels and what impact it can have, implications it can have on the open interest. The Nifty banking futures open interest, well, looking at a decline, which means there was also unwinding coming through here. In terms of the range, what we saw yesterday was maximum open interest in puts moving from 11,600 to 11,900. But as far as the 12,000 mark is concerned, in the terms of call, that remains intact. And well, this is some sort of an indication that we are likely to see some amount of range-bound trade moving in the next couple of days. And well, we did see a little more writing around the 12,000 put as well. Wonder what that means, but I guess today's day of trade will eventually give us an idea of. But the VIX came off by around 1.5%, still about the mark of 15, and the Nifty put-call ratio edging even higher to around 1.58, indicating and moving just slightly towards the overbought zone. As soon as it moves above 1.6, 1.7, well, it tends to start getting a little bit, overbought. Dish TV, Container Corp, and Torrent Pharma, among others, which are seeing an increase in open interest. And on the other hand, the stocks which saw a decline, we saw Vodafone Idea, Bharti, Airtel. Of course, this is after a lot of strength in these stocks over the past few days. And we continue to keep an eye on PSU banks. Alex, but I guess today will all be about the divestment stocks, Zee Entertainment and Diwan Housing Finance.
And the telecom stocks, of course.
Of course, yes.
All right, thanks so much for that, Agam. Now, let's talk about some of what Agam was just mentioning. The cabinet approved several decisions yesterday, but one of the headlines, of course, was the divestment roadmap that will see it sell its majority stake in 5 public sector utilities. The cabinet has also announced some relief for the cash-strapped telecom sector. Nikunj Ori outlines the important cabinet decisions in this report.
The Union Cabinet has approved strategic stake sale in 5 public sector companies where it has decided to let go of the management control and has decided to sell majority of its stake that the government currently holds in these companies. The first on the list is Bharat Petroleum Corporation, where the government will sell its entire 53% stake and give away the management control that the government currently enjoys. The catch here, the caveat here is that the government will not sell the 64% stake, 62% stake that BPCL currently holds in Numaligarh Refinery, and Numaligarh Refinery will be transferred to another oil public sector company. The other company on the list is Shipping Corporation of India, where the government is selling its entire 64% stake to a private buyer and along with the transfer of management control. The third company is Concor Container Corporation of India, where the government will sell its 31% stake out of the 55% stake that it currently holds in the company, and at the same time transfer the management control to the private buyer. The remaining 2 companies, Tehri Hydro Development Corporation and NEEPCO, will be sold to another public sector company, which is NTPC. Besides this, the government has also given its in-principle approval to divest the government's direct holding in select PSUs below 51%. This decision has been taken because the government could not come up with another tranche of ETF, since the companies that were part of the ETF had hit the 51% threshold, and the government had to take this approval to divest its stake below, divest its direct stakeholding in these companies below 51%. So now the government can go ahead with ETFs and divest stake in some of these companies like IOC, BMEL and MOIL below 51%. Lastly, the government has given a big relief to the telecom sector. It has decided to defer the spectrum payments of telecom companies for the year 2020, 2021 and 2021 to 2022. The deferred amount for these spectrum payments will be equally spread over remaining installment that these telecom companies will have to pay to the government.
All right. In fact, Nikunj also spoke to the Disinvestment Secretary Tuhin Kanta Pandey, where he explains the rationale for not divesting BPCL's Numaligarh facility or refinery and why the government will retain a 24% stake in Container Corporation. Listen in.
The strategic disinvestment to a private buyer will take place, but for Numaligarh, this carve-out has been there, as Honorable Finance Minister explained, that this will be carve-out and it will remain with another public sector buyer. So the sale will be made to another CPSC in oil and gas sector.
Okay, so will this mean that the government will divest Numaligarh refinery and get proceeds, divestment proceeds from that as well when it sells its stake to another CPSC?
Well, so far as the Numaligarh refinery is concerned, it is a BPCL subsidiary. Okay. Government does not have direct equity in it.
Okay, and sir, you've taken a decision to continue holding about 24% in Concor. What was the reason for that? Why not privatize it completely?
The Concor 24% is less than 26%, but the reasons for retention of the stake is on account of the fact that the Concor is Concor's operations are integrally linked to the railways so far, the way it has developed, and the competitive market will take some time to come of age in that sector. So the government has decided.
Will the strategic disinvestment be open for foreign buyers as well for all these 5 companies, except NEEPCO and THDC?
Well, there is no such restriction. It will be based on the expression of interest.
Okay. So another important decision has been to lower stakes in select PSUs below 51%, at the same time retaining management control. So what would be the way forward? This would be decided on a case-to-case basis. How would it be approved later, and how would you take a call whether to lower stake in each of these PSUs?
This will be, each case will be examined on its own merit, and it will be taken to the cabinet for approval.
Okay, my last question. So how hopeful are you of meeting your disinvestment target? By when do you see all these strategic disinvestments especially getting approved and the sale getting through?
We are doing our best, and strategic disinvestment is only one of the modes of disinvestment. We have other modes of disinvestment where a lot of shareholding we pass on to the public, and we increase the float and for the retail investors.
All right, stepping away from the cabinet decisions to another important development, the Reserve Bank of India has taken control of Diwan Housing Finance's board, and the regulator will also use the recently announced provision under the Insolvency and Bankruptcy Code for the resolution of the non-bank lender. Ida Dugal explains how this will play out in this report.
The Reserve Bank of India has finally stepped into the complex process of resolution of financial services firms. On Wednesday, the RBI said that it has decided to supersede the board of Diwan Housing Finance Limited. As you know, DHFL has been in default since June, and concerns about governance and other aspects of the firm have been swirling around since about January. This is what the RBI said. It said that it is exercising the powers that have been given to it under the RBI Act of 1934, and in the exercise of those powers, they have decided to supersede the board of Diwan Housing Finance Limited owing to governance concerns and the defaults by DHFL in meeting various payment obligations. The Reserve Bank of India went on to say that they have appointed an administrator. A former banker has been appointed as the administrator from DHFL. They will now be referring DHFL for resolution under the newly introduced window for financial services firms under the IBC. Just pause here for a minute, because I do want to mention that there are 2 major regulatory changes that have taken place to allow this to happen. Until the start of the year, the RBI actually did not have the powers to supersede the board of an NBFC. Also, the regulator for housing finance companies, which is what DHFL is, was the National Housing Bank. Now, in the budget of July, after the government was re-elected, they made 2 significant changes. One, they gave RBI powers to supersede the boards of NBFCs, and they brought regulation of HFCs under the RBI. So that prepared the RBI to take an action of this nature, which it can take in the course of banks. But then the question was that if you do that, how do you go about the resolution process? We don't have an FRDI bill, a financial resolution bill. So finally, earlier this week, the government put out rules and opened a special window under the IBC through which financial services providers will be resolved or can be resolved, non-bank financial services providers. Now, what is that process going to look like? The administrator who's been appointed it, will have pretty much the same powers as a resolution professional does under the IBC. The RBI is also likely, or can at least, appoint an advisory committee. This advisory committee, from what we understand, can be part outsiders, but also may include one insider so that they know the functioning of the firm and they can continue with it. There would be a moratorium which kicks in and commences on the date of initiation of the resolution process. Unlike in the case of other firms where it has to be admitted for insolvency, here the moratorium kicks in immediately. The provisions of the moratorium will not apply to any third-party assets or properties. We believe this should extend to securitized assets as well, but we'll see. This is the first case, so it's a test case. The license of the financial institution does not get suspended, so it can continue functioning to the extent that it has the wherewithal to function. So in this case, it can keep collecting from retail clients and can keep making payments on, say, securitized assets, etc. The administrator will eventually go back to the RBI to get a no objection once a resolution plan is approved. Now, that resolution plan will be approved via the main creditors of the DHFL in this case, or any other financial services company. They will approve a plan, they will take it to the RBI will say we have no objection, and then perhaps it can proceed. As part of that resolution plan, they also may try and bring in a large shareholder who then takes control of the firm. Now, we don't know what that resolution process will look like, but as BloombergQuint has reported over the last few months, there were a couple of proposals doing the rounds. One of them was to split the debt of DHFL, which is about 85,000 odd crore, into sustainable, which is largely the retail assets, and unsustainable, which is largely the developer loans. The retail assets perhaps can be mapped to retail liabilities, and that part can be a good bank which sort of continues. The bad bank would have to be restructured. The developer loans can be restructured. If you look at the next point, you will see that there would be some restructuring, some conversion of debt into equity, and then perhaps bringing in of a new shareholder. That would be part of the process as well. There is one complication here, which is the retail depositors. Remember, DHFL is a deposit-taking NBFC, so they have retail deposits. And from what we understand, the regulator is keen that a resolution plan accounts and makes provisions for retail depositors being paid on maturity. So that will be important to watch for those who have retail deposits with DHFL. But it's an important move. It tells you the regulator now has some level of control on non-bank lenders who may be falling into trouble. DHFL is one. Other NBFCs, or HFCs, we don't know whether the RBI will choose to take similar action, but they have the option to take this action, is what we now know.
Moving from one regulator to the other, I'm talking about market regulator SEBI. It had its board meeting yesterday, and there were several measures that were approved, new rules for portfolio managers and a higher threshold for their schemes. It has also cut the time frame for rights issues drastically, and also what has taken some people by surprise is the regulator's mandate that listed entities have to now declare any default to a financial institution within 31 days of the default. Sajit Mangat is here to tell you all about it. Sajit, several measures. How are you going to explain them to us?
Okay, there are three main issues which was considered by the board of SEBI yesterday. The first one being the crunching of timeline for rights issue once the approval comes in from the regulator. That has been brought down from 53 days after the date of after the board approves the rights issue to nearly 31 days. Now there is a further likelihood that it can be brought down by another 7 days if the amendments to the Companies Act is made, because currently the Companies Act requires a rights issue for a period of 14 days. So if that changes happen, then the entire timeline can be brought in further down. The second thing about rights issue is the trading of entitlement. Now these are rights entitlements which are traded in the off market as of today. The regulator is planning to bring in this trading of rights entitlement on the stock exchange platform, and once that happens, you're going to see a very robust trading happening and of issues, because any minority shareholder or shareholder who doesn't want to participate in the rights issue can sell their entitlement on the exchange platform and get a nominal amount from the sale of those entitlements. So that's one important thing which has been brought in and to the platform there. As far as the next big one is the portfolio management services, as we've been saying yesterday. the threshold has been increased from 25 to 50 lakhs, which means that any HNI which is now going to increase its or wants to get invest in a portfolio manager will have to put a minimum of 50 lakh rupees, or the addition, if someone wants to do a top up, he has to do it at least 25 lakhs so that it reaches the 50 lakh threshold. There is this will mean that there would be a churn or a reduction in number of people who can participate in portfolio management services. Now that has been some concern for the industry, because they've been trying to increase the coverage to over to as many as people, because the threshold was at as low as 25 lakhs there. From the portfolio manager's point of view, the net worth criteria has been enhanced from 2 lakh to 2 crores to 5 crores. Now they've been given 3 years to meet that 5 crore thing net worth. And that's pretty much in line with some of the recommendations which have been given. Aside of that, there has been some kind of transparency brought in the portfolio management services, which includes disclosure of all operational expenses, which is now been capped at 0.5%. All the charges needs to be made available to the investor at the time of entry. Also disclosure of the returns, which is now been made on a time weighted rate of return, which will be now similar to what what is going to be disclosed to the SEBI as today. So what happens is, basically now if the returns have been submitted to SEBI, the same returns have to be disclosed to the investors, so that there is uniformity and transparency in form of the returns which are coming in. So the host of issues, and the third big one which we've discussed already is the the regulator asking companies to disclose default on any loans taken from any financial institutions like banks. Currently, listed debt instruments are required, or default on listed debt instruments are required to be disclosed within 2 days. But when it comes to banks, there was an ambiguity there on disclosure. Now this makes them mandatory to disclose any default to bank loans within 30-day period.
All right, thanks so much for that, Sajid. Of course, all of this available on the website BloombergQuint.com if you'd like to have a closer look at that. For now, let's turn to the other big story. Subhash Chandra and his family will bring down their stake in Zee Entertainment to just about 5%. SL Group will sell approximately 16.5% stake in the group's flagship firm. Yatin Mota is joining me now to tell you more about this story. Yatin, the release that we saw yesterday mentions that a Chinese fund is looking to buy a little more than 2% stake. But what about the remaining 14%? And also, is there any understanding about the price at which this is going to be sold?
Yeah, so Alex, let me talk about the version that the promoter group has sent to the stock exchanges as well as media. Now, the SL Group is looking to sell close to 16.5% stake in Zee Entertainment, and post this transaction of 16.5%, the promoters would continue to hold close to 5% equity in the listed entity. More importantly, we have OFI Global, which is a Chinese fund. They would be buying close to 2.3% stake in Zee. Remember, they already hold a 8.5% stake in Zee as of now. More importantly, we also had the terms of the block deal, which is likely to happen today. Citi is the sole broker as far as the transaction is concerned, according to our sources. Now, the promoters intend to sell close to 15 crore shares in the open market via bulk deals, and the base price for this transaction is set at 277 rupees per share. Of course, base price doesn't necessarily mean the shares will trade at 277 rupees per share, but depending on the demand as well as the book building process which is running with the institutional investors will determine the price point at which the block deal can happen. More importantly, if you look at the post-transaction shareholding of the SL Group, now Oppenheimer Invesco will hold close to 18.8% stake. OFI China, post acquiring the 2.3% as disclosed by the promoters, will hold close to 11%. Vanguard 8% odd, as well as the SL Group will continue to hold 5% according to our calculations. So broadly, now the promoters will be only having a 5% equity stake in Zee. It's to be seen if there is some kind of a takeover activity moving ahead. But as of now, it seems that the promoters, given the fact that they are sitting on huge leverage, have probably lost a substantial amount of shares as well as holding in the company. Today, Zee, however, has been upgraded by Morgan Stanley with a target price of 340, and they do believe this equal weight rating is largely to do with the overhang of the pledge shares gone, because earlier there was a chance that the lender might have sold the shares in the open market, leading to a fall in share price, and that is behind us, according to Morgan Stanley in the early morning note.
Thanks so much for that, Yatin. Clearly, a stock that you have to watch out for and trade today, apart from the ones that we've already spoken about, but there are several more. And Soumit Sarkar is here to tell you all about the stocks in news. Good morning, Soumit. We've spoken about several big names already. What's on your list today?
Well, on the smaller side, firstly, Union Bank of India, where they have come out with the divergence report. They are saying that there's a divergence in net NPA for around 589 crore rupees. Divergence in provisioning stands at close to 1,600 crore rupees, and the net loss adjusted for this divergence would have been close to 4,000 crore rupees versus 3,000. That is the bank reported. Aurobindo Pharma, because USFDA has sent Form 483 with observations to the company for their October inspection. Dilip Buildcon, because they have received a provisional certificate for completion of their HAM project in Maharashtra ahead of the schedule. Great Eastern Shipping, because they have signed a contract to sell the crude carrier vessel, which will be delivered to the new buyer in the third quarter of financial year 2020. Canara Bank and Syndicate Bank will also remain in focus, because the Ministry of Finance has given an in-principle approval to the proposed amalgamation of Syndicate Bank into Canara Bank, and Union Bank, Oriental Bank and Punjab National Bank will also remain in focus, because they have also received this in-principle approval. Lastly, in pledge share details, Yes Bank promoter Madhu Kapoor has released pledge on 1.12 crore shares on November 13th.
All right, thanks so much for that, Soumit. Well, we've spoken about several large developments from a market close yesterday to now, and of course there's going to be lots more that we speak about during the trade setup when we launch into the market trade today. So do stay tuned, there's lots to talk about. This is BloombergQuint.